This is Gurula, Markets with May. It is Friday, January the 21st. This is our daily show and daily commentary, and the markets are quite crazy today. I'm going to share my screen here in just a second. David, let me know if you can't see it so that we can make sure that we don't have that issue. Share screen options. Oops, hold on. Okay, so this is what the market looks like today. I'm using FinViz, great app that is not currently sponsoring us in any way, shape, or form, but I just like to see this heat map of what's going on within the S&P 500. All of these are S&P 500 names, and as you can see, there really aren't any real safe havens. Consumer defensive, or so it's called, is actually one of the few areas that's green. I'm actually shocked that the restaurants are in the green today, and UNH, which I have been a fan of, as well as some of the Cigna, et cetera, they're down very little. But mostly it's all coming from the crappy Netflix earnings report from yesterday, which strangely enough, I was like, why? 20% is so aggressive to knock something down. They came in ever so slightly, just a baby hair, less than what people expected, like 2 million less, like something ridiculously small. But the guidance for next year is more or less flat from the previous year. So I think people are worried about growth. They actually were getting pricing. But I think the more important thing is why 20%. And why 20% really is this continuous and multiple compression that we've been getting off of growth stocks over the last few weeks. Interestingly enough, Silicon Valley Bank also reported earnings these last couple days. And Silicon Valley Bank is my bellwether for middle markets lending and private equity, because they essentially are a bank out of Silicon Valley. All of their customers are in the tech world, more or less, or wine connoisseurs or what have you. They do loans to vineyards and stuff like that. Silicon Valley Bank is an amazing bank. They always report earnings that makes it look like a tech company, because quite frankly, they make more off the warrants that they receive and aiding in financing for tech than anything else. But Silicon Valley Bank is getting clobbered today just along with everybody else, because, and I really got a sense from the investors what the concern was. I think more than anything else, that call was very telling for a particular type of investor. And that is the idea that if multiples start to shrink within technology, their concern as investors was that perhaps that would slow the middle market's business up. Now, Silicon Valley Bank answered the same way I would have, which is that's ridiculous. Right now, these companies have a ton of cash, and the desire to acquire others is quite for future growth or for strategic stuff is actually really, really at an all-time high. And if you think about it, half the acquisitions that are really interesting are things like Microsoft's purchase of Activision, which is really yes, Activision has these crazy, amazing assets that are incredible cash flow mechanisms, regardless of whether you add more bells and whistles to it. But more than anything, Activision has this amazing headcount. And I think we see more acquisitions that are headcount based from these smaller companies as we go, because it is still the case that the youth of America and the talent of America prefers the potential upside of going to a smaller company versus larger companies. And that's just what we see happening. Now, interestingly enough, PayPal finally, and it makes me want to scream at the top of my lungs, is down 4.73%. It is the highest valued credit card company in the space, and it kills me that I was out of my short position a little bit early because I was afraid of earnings next week on Wednesday. But I would say that if you're profitable on this, I wouldn't go too aggressively past Monday. So with that, I do want to start in on some of the macro that we are seeing. Let me know if you cannot see my screen, but I'm just showing the Market Watch calendar for next week. Next week is really, you can look at all of these things. You've got PMI, which is going to give you a sense for manufacturing. It's largely going to be uneventful, quite frankly, no matter what it says, because we do have the infrastructure bill, which will kick in later. And then we've got consumer confidence that people are worried about. But the thing that I think, unless both those numbers come in crazy good, we're probably not going to get people aggressively coming in until after this FOMC meeting. And I'm really looking to be very chilled and much more hedged up, if not slightly negative, until this FOMC meeting. The only caveat to that is, how does the market trade Monday and Tuesday? But even if the market trades up on Monday, I don't think people go into these 2 days without some significant hedging going on. And I think people even take opportunities to continue to sell. Why is that? Let me show you this earnings whisper website, which is habitually wrong, but still gives you a decent idea on what's reporting earnings. It just has to do with how data feeds work. It's not their fault. But if you look on Monday, you only have 28 companies reporting earnings according to them. In my world, that's literally like maybe 5 or 6 companies, which means 5 or 6 large cap companies that could really shift the market on Monday. There's really not that much. And then for the remainder of the week, you have closer to for them, it's like 150 companies. For me, it's something like 100 companies reporting next week. And then the following week, you're going to get like the massive over 200 companies in the S&P 500 reporting. Then you'll have it back down to about 150 the week after. So we have this incredible flood of new information that's coming in next week, not the least of which is you have Microsoft reporting, Intel reporting, and some of your real bellwethers reporting next week. And then the following week, you get your Amazon, you get stuff like that. In light of that lack of information, I don't see people coming in here so aggressively. I see people taking nibbles here and there on specific names, but I think you got to just be really, really careful, because it is a momentum-based market. Another way to think of it is, in order for me to buy it, you're going to have to give me a discount because I'm scared. And that's what we're seeing here. This happens a lot as well, even though we started the month with everybody saying, oh, January is like the greatest month ever. It usually trades up. I was like, what are you talking about? Because last year it traded down as well. And you really have to, I think that they just misunderstood. If you have a really strong year previous, you do still get follow through tax loss, taxable gains selling in the month of January, because people do then finally have the closer to final estimates in the month of January on what it is they owe the government, et cetera. So there's a lot of that I think is still in here in the marketplace, where you really do just want to be hedged up. Now, that said, I am definitely in this market today buying things that I think typically I may not get another chance to. Now, I'm not taking the full position, but I've been accumulating throughout this period, and that really has been the energy sector. If we look again on the energy sector, we can kind of see here in basic materials. There's a few in basic materials that I'm intrigued about, but I do want to talk about PPG, which reported earnings. But the energy sector in general, still in fuego. Still an area where I believe we have shortage. It is really cold, and it's not letting up yet. Like, I watched the 10-day report across the nation like a hawk, and I'm just telling you, it is cold, and that is a problem. So I don't know why energy isn't on here on this heat map. Oh, over here. So we see it red today. The XLE, I would continue to take advantage of it, and just nibble, set limit orders lower than market, see if you can get it done. Because this whole sector is going to rally. I want to show you Schlumberger's earnings report. Schlumberger is a bellwether. It does oil equipment. Well, actually does all kinds of nat gas equipment, et cetera. But you do see revenue up 6% sequentially, 13% year over year. Now, you have to remember that 6% sequentially, 13% year on year, this is actually escalating and increasing because last year you started to finally come out of some of the weakness that we were seeing within the energy sector. But if you look, they have economy of scale. So 6% to 8% may not seem like a lot, but 13% to 56% for next year is quite a lot. What am I trying to say? I'm saying that North America clearly needs, we are the place that you're going to go to when oil is doing over $60 a gallon. And internationally, we're starting to see that pick up as well. And this bodes really well, and it tells you, since we're the low-cost producer and since certain things are going a certain way, that the demand for oil is there. We can also see that by simply going and looking at crude oil prices, which remain very sticky. Every time people try to short this crude oil price down to the $80 level, it just bounces straight back up. I think it was as low today as 84, and then immediately you had buyers come in and try to get it. And that's just a function of the fact that there's a real shortage, period. Yeah, so, nothing changed on my thesis there. If anything, I think the other one that you may want to consider is Freeport-McMoRan. Hopefully I pronounced that right this time. I don't know why I can never pronounce that right. But FCX, that gives you exposure to copper, gold, and molybdenum. So it's just something to take note of. Now, the other earnings reports that I think are really important to take a look at is the trains, the rails. I always look at them because they give great intelligence on what just happened. And if we look at this, I want to remind you that the other side of us, the algo side, did mention a short on Ford a few weeks ago. I did buy some puts very quietly, but I probably should have talked a bit more. But I usually look at this, the trains and the rails to tell me. This is CSX. They have rails that are right down the middle of the country. So it really absolutely leads the state of Michigan straight down. And we see automotive still weak. So this, whereas I also look at Kansas Southern and Union Pacific. Union Pacific and Kansas Southern have ports that are near the water and come up through the United States in a particular way. But CSX really tells you what's happening in Michigan specifically. And we do have automotive. So you got to think about, if you're just trying to figure out how many cars got moved off the lots in Michigan and then delivered to the rest of the United States, it's still a weak number. And it's been continuously weak throughout the entire period. Since the semi shortage has been going nuts. I do want to mention that minerals, ag food, and fertilizers is still in hot demand. And we've got, literally every other part of the economy is delivering like crazy. This coal up 39% tells you that energy as well, very, very bullish. Because essentially, because you have such an elevated price in nat gas and oil, the coal is used by utilities companies to try to warm all of us. If you are long coal, I would continue to keep your long positions on. The U.S. is a low-cost producer of coal, and if we are still seeing demand like this, every other country is also seeing this. The other country that does import-export coal is going to be China, but China right now is having an energy shortage, so they are essentially retaining all of their coal, which always bodes well for the rest of the world's energy complex, if you will. But, these train companies don't lie. And this would have been up through the December period, which means it doesn't even really truly incorporate these freezing cold temperatures that we're getting across the United States. And it's just really crazy bullish. This up 8% is insane, and let me tell you why. This is part of the Mosaic story. Also minerals, because it might just be that some of the number is in here as well. Also Mosaic. And that really just is that this is not the growing season. This number is more exciting when it's in the spring, but the fact that it's up is just pure margin because Mosaic has already been very clear that it will be raising prices throughout the year, and no one is confused that it will be doing so. Ag and food products, this really affects your John Deere in a positive way. I've been bullish on that, although currently I don't have a position in it. And then chemicals and forest products, metals, et cetera, you can see that the demand is still there. It's what we've been seeing. So even if the PMI numbers come out strange and awkward, this really still represents a need for the United States to reaccumulate supply given the drawdowns that happened last year. How that will affect each individual company, we still have to see more, but this is something that I definitely watch to understand the story that's going on. Here is Union Pacific's earnings calls. They really echoed the same thing. Automotive down 10 for them. So you do still see very, very particular look of how things are. They are estimating. Now, this one's interesting. I always like how they do economic forecasts because, quite frankly, they do really, really good economic work. And if we're looking at light vehicle sales, they're actually expecting, because of the semi issue, and this is what they said, this was also said in the CSX call, they don't see it fully recovering their light vehicle sales, meaning, you know, actually getting these cars onto the rail so that it could then be transported and sold until the end of the second quarter, but alleviating slightly. So this is how they're seeing the world. And then they see that excess demand getting sopped up. Now, does this actually have any implication to Tesla? I don't think so, because Tesla produces such a significantly smaller percentage of cars in the US than Ford and GM. But it's just something to take a look at. Yeah. And that is, let's see, otherwise, that is about, yeah, that covers everything that I've got. Oh, one other thing. I've been really shocked by how much people are bidding down healthcare stocks. So for example, I know everybody is like, oh, because the thing is over, you know, I'm so over it, Moderna, la, la, la. But the fact is Moderna is right now at 160, the cheapest large cap healthcare company. That said, I think the technicals are really effing scary to go long Moderna right now at 10.6 times. This probably doesn't make any sense, both from the perspective that vaccinations are probably going to be like flu vaccines, and that at 10 times does not represent that. Additionally, this is a crazy valuation because Moderna has a huge war chest now in cash to support all of its other things that it might like to do. Similarly, Pfizer is getting beaten up in a way that probably does not, like at 9.4 times, I almost prefer, actually that just happened today before it was, Moderna was a little bit cheaper. But both of these companies are pretty cheap. If you wanted to nibble today, I think that you still want to be careful because they both report earnings in mid to late February. So that might be why there is a little bit of a hesitation to come in here in any kind of aggressive, meaningful way to support the stocks. And with that, I will take any questions that are going on. Any questions? David? Okay, if there are no questions, I guess the other thing I would just say, one of the things that I did, oh, Tesla. Yeah, with Tesla, I would just be a little bit careful with Tesla. But in fairness, again, even though the automotive companies, you know, the thing is, I think that Tesla is not fully incorporated. First of all, Tesla does pre-sales much better than the other two auto manufacturers do. Second, and more importantly, Tesla, the real challenge with Tesla right now is valuation. If people are just trying to find places to take profits, Tesla might get beaten up for no reason. Tesla does have some numbers that are coming out next week. It used to be that because Elon was so loosey-goosey on that call, the thing would trade down. But the last call, he brought in another guy to help facilitate. And that guy actually sounds really good on the call. Like he does sound a little bit more like what the street would be accustomed to, giving guidance, giving a much cleaner discussion of strategy. And I think in a lot of ways, he must kind of be reining the crazy things that Elon says on the call in. So I wouldn't necessarily go short or long Tesla here into that report because you don't know how it will necessarily react afterwards. Plus, it happens right on top of the FOMC meeting. So if we do catch a bid after the FOMC meeting, then we're going to be off into the races pretty aggressively because the fact is these companies are actually reporting pretty well. So I'm very hesitant to lay on shorts in this kind of environment. Maybe the airlines, I still think there's going to be at some point some loss of love for them because right now they're really being held together by a hope and a dream more than anything else. That'd be the one industry that you could probably find shorts on. But since I'm up in those names like 200-300% from the time I shorted them after Delta reported, it's a question of whether or not those shorts are getting long in the tooth and there might just be a breather on it. Oh, okay. So we do still need to see the yield curve lift for the next 3 days. I think the market's just going to, what you're seeing more within bonds is just a flight to safety, because the TLT is up a bit, and I think it's just simply a flight to safety. The other thing that we could fly to safety in is actually that Activision. So I will probably buy more of that Activision call spread that we talked about yesterday. Tonight before the close, and that's simply because Microsoft said they're paying $95. Microsoft ain't going back out of that, so that's just free money. The only thing that could really stop that is maybe a minor news flow blip that would happen as someone tries to stop Microsoft from acquiring that talent, just because they're Microsoft and people like to stop them from doing stuff from time to time. Alternatively, it could be one of the competitors, Electronic Arts potentially, but I don't think there could be anything interesting. Netflix buy another gamer. Yeah, I mean, I think in general, possibly Netflix would have been an acquirer of something like, that's why I say, like, if the deal breaks, all that's going to happen is someone else is going to buy that talent at $95 because it's already the stated price. And if, given what I'm seeing on labor, $95 might not even be the right price if the deal breaks 3 months from now. If the deal breaks today, $95 will stay the price. But if the deal breaks in 3 months, it's hard to say that $95 is the right price and you've been able to retain the talent. So Activision to me is one of the better and safer places if you're just trying to go somewhere to hide. Again, if you wanted to hide in energy, you should hide in energy. Freeport-McMoRan, if you want to hide there, that's fine. You could actually, oddly enough, hide in Bitcoin, and the way you do it is you buy BITO, and you would buy puts on BITO at the same time, because 1 to 2 week puts that will get you through the FOMC meeting are only like 60 cents right now. So you would essentially go long long one way, short the other way on BITO, actually on Bitcoin actually regaining its price. Now, why do we potentially want to be long Bitcoin right now? Because we want to be long Bitcoin because essentially globally things are actually not as strong as they are in the United States. The dollar will continue to strengthen, and if you're a foreign country holding either US dollar reserves, which you might have one feeling about, but you do want to diversify your reserves, the renminbi might be a little scary for you to diversify in, even if ultimately you want to be long the renminbi. But China, I'm not thinking that they are going to show strong economic strength in the next year or so. I actually expect that they'll be at the lower end of GDP guidance. So the renminbi, which is 2% of all reserve currencies, is not a safe haven from a reserve currency perspective if you're not a U.S. country. Then you've got the euro. That's not where you want to be right now. We're coming off a LIBOR, so there'll be volatility across all of that entire spectrum. So using the euro as a reserve currency is a little bit scary. Bitcoin is a legitimate thing, as is gold. Freeport-McMoRan, what do they mine? Gold. You know what I'm saying? That's one of the reasons why I'm like, knock yourself out on Freeport-McMoRan at these levels. And then Bitcoin, if you buy the puts on the other side to protect yourself and insure yourself, is a wonderful thing to do right now. So those would be also things you could do. Other questions? These are great questions. Let's see what we got. Yeah. So hopefully that covers those items. Any other questions before I let you get back to a very bloody market today? All right. I'm going to go ahead and end the recording then. Thanks for coming. See you guys tomorrow, or Monday, I guess it is.